Hello and welcome. You're watching Business Today TV. I'm Sakshi, Batra, and this is Market Today, a show where we'll help you understand all the latest cues from the D Street, starting from the benchmark index moves to sectoral indices and also the stocks that are reacting positively. Of course, we've seen the big RBI policy now out. The RBI has hit the pause button and has decided to keep the key benchmark policy rates unchanged at 6.5%, even as inflation is trending above the tolerance level as well. But look at the kind of reaction that we've got from the markets. It's a thumbs up. The markets wiped off the early losses. Sensex and the Nifty right now a 0.25% up, 17,600 for the Nifty right now, 59,838, about 150 points up for the Sensex today, 0.25% uptick, and it's a broad-based buying action that you can actually see. Starting from the broader markets, the mid and the small cap 100 indices, both reacting positively. In fact, both of them are outperforming the benchmarks as well. About 0.6% of an uptick can actually be seen on both these broader market index levels as well. When we talk about the sectoral moves also, if you barring about just two indices, the FMCG and the IT pack, rest all of the Nifty sectors are actually up in the green, with sharp moves being seen on the Realty pack. For example, it's 2% up in trade. The banks are moving higher, with the Nifty Bank up by 0.3% odd at 41,133, and all constituents also moving higher. Financial services 0.5% up. PSU banks about 0.8% uptick. It can actually be seen for that one. Private banks slowly but steadily, about 0.3% of an uptick can actually be seen for that one as well. Metals, pharma, all of them are moving in tandem in trade today. In terms of the kind of move that we can expect going forward from here, we'll be joined by an expert right here to understand more about what the RBI's decisions really mean for markets and for the investors as well. Let's welcome our guest on the show. Mr. Sudip Bandyopadhyay joins in, Group Chairman, Inditrade Capital. Welcome, sir, and thank you so much for taking the time out for this discussion. Well, the first, your own first reaction to the RBI policy and the announcements right there. The rate hike cycle has been paused after 6 consecutive rate increases that we had seen. Your own thoughts? Were you pleasantly surprised with this move?
Well, I think it's definitely a positive surprise. Predominant view in the market had been that the repo rate will go up by 25 basis points. And when the RBI governor chose to keep the repo rate at 6.5 and clearly indicated that there's no need for a hike at this stage, I think the market was pleasantly surprised, and the thumbs up of the market is reflected in the way the share prices moved post this announcement. We also had a mild positive surprise when he upped the GDP forecast for the fiscal to 6.5% from 6.4%. I think that also has been a kind of a stamp of confidence which the RBI has on the Indian economy, and that does augur well as far as the market view and market the future is concerned. I would say that RBI took a very pragmatic view. Yes, inflation is beyond RBI's tolerance level, and if we look at only that parameter, probably RBI should continue hiking the rates. But the reality on the other side is, I think the higher rates have already started pinching. They may not be pinching at the high end consumers, higher income population, but as we know, India is largely a low and medium income country, and it has started pinching there, and it's getting reflected in a bit of a slowdown in demand in semi-urban rural areas. And this doesn't bode well for the future of the economy as well as the markets. So this pause, I would say, is an excellent step. We have seen how rate increases can hurt the overall financial system and the economy in US when we saw the banks started collapsing. Yes. So under the circumstances, it's an extremely pragmatic and prudent policy by RBI to wait and watch. They haven't abandoned their tight monetary policy stand. They haven't moved away to accommodation. Very clearly, the governor indicated that they are pausing and they will wait and watch the trends and then take appropriate call at appropriate time. I think this is the best course of action under the current circumstances, and market is giving thumbs up for that.
Absolutely, the markets have given thumbs up on that. 200 points up right now for the Sensex right here at this point in time. But would this be a step that the markets will be able to sustain these kind of an upside levels that we are seeing on a sustained basis going forward from here? Because, you know, we've been seeing a whole lot of volatility in the markets. Now that this step has been taken by the RBI, which you say is a pragmatic and an excellent approach, will that give enough fillip to the markets to sustain these levels on the upside?
Well, it definitely has given market a leg to look forward and look at moving higher, and that's what is happening. A lot will depend on a few things. One is how the global market moves, because to a great extent, Indian market still gets driven by the FII's risk aversion or otherwise. So we'll have to watch what the US markets, how the US market moves, and that unfortunately is a reality. The second factor which we will have to carefully watch is the corporate results. I think from next week onwards, corporate results will start streaming in, and if the results are better than expected, I think market will start moving into a higher trajectory. We'll have to wait and watch. There are some causes of concern. One, of course, the OPEC has decided to cut oil production, and that has pushed up the crude oil prices already. We have to wait and watch that space carefully. There is a talk of El Nino, coming in from July, and that may affect the distribution of rainfall and the spread of rainfall. We should get the rains, monsoon rains, before El Nino steps in, but the distribution and the volume of rain will again depend on El Nino. We will hope for a milder version of disruption, and hope that doesn't disrupt agriculture, which in turn can have a significant negative impact on Indian markets.
Absolutely. Mr. Bandyopadhyay, I'll come back to you. Let's, for all our viewers who have actually missed listening to the governor and his speech, we have a slice of the announcements that he made. Let's listen in.
The Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6.5% in this meeting of the MPC, with readiness to act should the situation so warrant. Consequently, the standing deposit facility, that is SDF rate, will remain unchanged at 6.25%, and the marginal standing facility, that is the MSF rate, and the bank rate at 6.75%. The banking and non-banking financial service sectors in India remain healthy, and financial markets have evolved in an orderly manner. Economic activity remains resilient, and real GDP growth is expected to have been 7% in 22-23. Consumer price inflation, however, has increased since December 2022, driven by price pressures on cereals, milk, and fruits. Core inflation remains elevated. The Monetary Policy Committee.
All right, and that was the governor really talking about, while the pause has been taken, but the MPC will not think twice in case should the situations warrant, they can actually go ahead and again look at raising the rates as well. I wanted to understand from you, Mr. Bandyopadhyay, what could be that pivot, because in the press conference, the governor really clarified it is a pause but not a pivot. So what could trigger that pivot really?
Pivot clearly will come when the inflation starts coming down. I think RBI is mandated to keep the inflation within band, which I think the upper end of the band is about 4%. We are significantly above that band. And when RBI sees the inflation coming down, and the trend clearly is that is moving downwards, the pivot as far as the policy will come. Easy money policy is probably a prerequisite for rapid GDP growth, and pretty much everybody understands that. But on the other hand, inflation beyond a point cannot be tolerated. So the RBI has to always keep balancing these two things, and they have to keep a very tight watch and tight monitoring of these two factors. And as and when the inflation starts coming down, they will pivot towards the easy monetary policy.
Absolutely. But in your own sense, would this be a prolonged pause, at least for a couple of quarters, if we can anticipate?
Well, Sakshi, I will say this that we live in a dynamic world. There are so many things happening. It is extremely difficult for anybody, even the RBI governor or anybody, to predict, what will happen to the global oil prices. We are dependent on certain external factors. So inflation has two components. One is domestic, one is imported. Now the oil and metal prices are the imported, comprise the imported component of inflation. Nobody has control of it. The domestic part, I think to a great extent, will depend on how the agriculture is. If the agriculture is good, I think the domestic inflation, particularly food inflation, will start coming down, and that will give RBI enough leeway to start, pivoting and cutting interest rates at some stage later in the financial year. We have to wait. I think unless there are some drastic events, probably things will start changing for the better towards the second half of current fiscal.
Okay, understood that. Why I also asked you this is because a lot of investors may now be looking at understanding what should be their approach to investments. Now, be it to equities or be it to the fixed income assets or be it to gold as well. So, coming to that, first up on the equities bit, let's understand. Given the decision that the RBI has now taken, what would you really advise the investors, retail investors at large? How should they be now approaching their investments in equities?
Well, my advice to retail investors will be that they should continue to follow what we have been saying for last few months. Yes, RBI is definitely a positive, and market is reflecting that. But fundamentals on the ground haven't changed. The volatility is here to stay. So, if you are a long-term investor, definitely start picking up good quality stocks, provided you have a time horizon of 1 year plus. And that has been my standard advice to investors. I will continue with that. Uh, Nothing has changed as far as medium to long term Indian stock market is concerned. So
Right.
if you have identified a good company, do pick up and hold it. As
Right.
far as other asset categories you did mention, gold of course has shot
Yeah,
significantly.
Mr. Bandyopadhyay, I'll come to gold as well. But in equities, like you said, you're talking about stock-specific action, picking up good, fundamentally strong companies in your portfolio at this point in time. But what does this decision really do to the rate-sensitive sectors, for example? Should one concentrate their focus there and look for some good companies from those? Or are there other sectors that you're bullish on, the themes that you may be now looking to trap?
BFSI, which is rate sensitive to a great extent, has been our favorite for quite some time. And this pause by RBI will definitely help BFSI. The leading companies in the BFSI space, particularly the banks, whether it's the largest private public sector bank, SBI, or some of the large private sector banks, can definitely be looked at for portfolio addition at this stage. We like construction and infrastructure sector, significant tailwind behind the sector. Government is committed to spend a huge amount as per the budget, and a lot of this money will go for construction infrastructure. We also have to remember that the central elections are coming; they are 1 year plus away. Under these circumstances, one should focus on companies like Larsen Toubro. That's a very, very safe bet, 1 year plus
Okay.
time.
Okay. And from the BFSI space, any specific names?
I did mention SBI. I can also safely recommend HDFC Bank. I think these can be looked at current price.
What about the Realty pack? That's reacted quite strongly, and we've been seeing some very strong demand on ground as well, especially when it comes to the luxury projects. They are being sold as soon as they are being announced, so some huge demand being seen for that. Anything that's interesting from this pack for you?
I will not probably get carried away by the recent excitement on luxury flat sales, because I think a lot of it had to do with capital gains tax adjustment before 31st March. And as we know that to a great extent that benefit has been withdrawn. Now it's only limited to 10 crores. So probably there were a lot of adjustments going on. But fundamentally, we like the residential and even commercial real estate players. So some of these companies which have a clean and strong balance sheet are in our recommendation list. We do like Godrej companies. They are amongst three large urban agglomerations of NCR, Mumbai, and Pune. That can be definitely looked at. We can look at also some of the other companies like Realty, DLF, Shubha. Some of them can be picked up, but remember when I'm recommending all this, these are 1 year plus time horizon.
Sure. Sure. Point taken. And you were talking about, approach to gold. We've been seeing that gold prices are at all-time high levels. What is the kind of thought process that you have on this asset class, and has anything changed after the RBI's decision today?
Not really, not anything has changed post RBI. I think gold is a safe haven. It's construed as a safe haven world over for thousands of years, and that's what we have seen getting played out once again when there was crisis kind of a feeling in the US markets and Europe. Gold prices did shot up. They are trading at close to all-time highs. Under these circumstances, I'm not recommending investors to rush and buy gold, but 10% of your portfolio should be in gold. That's what has been our belief always, and we maintain that. And if you are planning to invest in gold, I will continue to say don't invest in jewelry, buy gold bonds or something, some such thing.
Okay. What about the fixed income instruments? I mean, we've been looking at how FD rates have been shooting higher. Conservative investors have now been shifting out their money from equities to FDs, thinking that, you're getting a guaranteed 7+ percentage interest rate on 3 years plus kind of an investment right there. So that's the kind of horizon they have, and they are approaching FDs with a renewed focus, especially now after the finance bill amendments as well. There is more focus on FD rather than debt funds as well. Your thoughts? And now that the pause has, we've seen the pause on the RBI's policy rate hikes, no more rate hikes coming in, so depositors cannot be looking at higher rates from here perhaps, at least for the time being. What would your suggestion be?
FD rates are reasonable, I would say, compared to what it was, consequent upon all these rate hikes by RBI over the last, I think, 1.5 years. So definitely the arbitrage between mutual fund units, debt mutual fund units and FD, that has been taken off finance bill. So FD does become attractive for a certain segment of the investors who are fundamentally risk averse, but we are still flocking to debt mutual funds for the sake of getting a little higher return. I would say if you are completely risk averse, pick up a good bank's FD for a slightly longer duration and remain there. There is absolutely no harm. You don't necessarily need to buy into mutual fund, debt mutual fund. Debt mutual fund also can be attractive for a little more aggressive investors who are looking at a different quality of papers, and that's the reason we saw a lot of investment coming into fixed maturity papers and things like that, where the fund is picking up a one or few corporate papers which are higher yielding. But these are a little more risky, definitely, compared to bank FD. So one has to take their call for the sake of higher return. Are you willing to compromise on the risk?
Okay, well, thank you so much, Mr. Bandyopadhyay, for being with us on the show and discussing all these insights from the RBI policies, meeting and the decisions taken there for the market participants and the investors, the way now they should be approaching their investments to other asset classes and to equities as well. Always a pleasure having you with us on Business Today TV. Let's now keep an eye out on how the markets are reacting even now. Still holding up to 20 points up for the Sensex, 59,909, the current level. Talk about the Nifty, 17,624. So we are seeing the build up on gains, about 0.4% of an uptick on the Nifty right now, and these gains are coming broad based. The broader markets are participating, the Nifty bank is moving higher as well, and some of these rate sensitive sectors are also moving and reacting to this unexpected move by the RBI today to pause the hike in the interest rate cycle as well. We'll continue to track this development and see what are the other expert comments really coming out to help you really understand the ways that you should be approaching your investments post this RBI policy decision. And for that, you need to stick with us. Don't forget to subscribe to this channel and also continue to engage with us on our other social media platforms, that's Facebook, Twitter, LinkedIn and Instagram. Until then, many thanks for tuning in.